Good day, everyone. My name is Chidalwe Chem, and it is my utmost pleasure to welcome you all to our first webinar of the year themed 2023 Capital Market Outlook, Positioning for Long-Term Wealth, courtesy of Silvest Financial Services. Now, investing in global capital markets has become a tad bit confusing for many investors, and I guess I speak the minds of many investors with these questions. How will the current actions by central banks in managing inflation affect portfolios? How can we navigate the uncertainties in the capital markets? What is the outlook for the Nigerian capital markets, especially in the face of the upcoming elections? And then many more questions. Therefore, we thought it important to invite the Savest research team to speak to us on these arising questions, give us their professional opinion on the implication of the answers, and how we can navigate these issues and better position our investments to actively build long-term wealth. Now, I would like everyone to sit back, engage the speaker, and enjoy the session. I also encourage everyone to ask questions for better understanding. If you have any questions, you can type them in the Q&A box, and I will definitely get to them in the course of the session. Now, there is a disclaimer which is pinned in the chat box. No information given here should be construed as investment advice. Investment carries significant risk and requires the professional advice of a competent investment advisor. Now, moving on, it is my utmost pleasure to invite our guest speaker for this event. He'll be taking us through the distinct topic and session. Nathan Walker is the founder and managing director, of Silvest Financial Services Limited, with over 17 years experience in the financial services sector. He spent 11 years at Zenith Bank PLC and 4 years at Cowrie Asset Management, where he managed investments for many individuals and institutions. In the last 2 years, he has led Savest to secure a license from the Nigerian Securities and Exchange Commission, SEC, as a corporate investment advisor. At Savest, Nathan serves many clients, families, and institutions, helping them to make informed decisions around wealth planning, estate planning, legacy planning, and fund management. He is a chartered financial analyst and a member of the CFA Society of Nigeria. Welcome, Nathan.
Thank you, Chidalu.
All right. You're welcome. Now, Nathan, thank you for taking the time to speak to us on today's topic. I think we're poised to start now. Is that okay?
Sure, we are.
All right. Okay. Thank you very much. Nathan, I will start with this. We're talking of the 2023 capital market outlook. We do know that sometimes we can't speak of the present or the future without touching on things from the past that are still affecting the current. I don't know if that made sense. So last year, inflation was a hot topic around the world due to the global events relating to COVID-19. We had the supply chain issues. We also had the Russian invasion of Ukraine, which all these things culminated to upend the global trade. Now, I think as of last year, U.S. inflation rates reached a 40-year high of about 9.1% in June. And the Nigerian inflation rate for December 2022 was at 21.34%, while the Eurozone's annual inflation was at 9.2%. Now, these inflation rates have led to hikes in interest rates in a lot of countries all over the world, and currently there are still fears of recession. Now, the question, Nathan, is where are we today globally?
Okay, Chidalu, thank you so much. I'm trying to get my presentation up. Okay, take a minute.
Okay, Nathan, while we wait for you, in the course of the session, you can ask your questions in the Q&A box. So if you have any questions at all, just put them in the Q&A box and we'll get to them in the course of the session.
Just let me know if you can see the slides now.
Yes, Nathan, I can see your slide.
Okay, so let's get into it.
Okay.
All right, so for last year, I'm sure last year is a year that most investors will want to forget and put behind them. Everything was bad for last year. For the first time in a country like the USA, both the equities and the bond market declined in the same year. This has not happened since 1969. And it was the same story for the Eurozone market, for Asia, and most of the African markets. And you add that to the fact that the alternative assets that a lot of us were invested in, like cryptocurrencies, real estate, both locally and internationally, all of this declined last year. So it was a very terrible year for global investors. But then the question is, was it just about inflation? I don't think so. The issue last year was not just about inflation. Now, what we see at Savers is some sort of reset going on with global economies around the world. And this reset started from 2020. Now, if you think about the pillars that have supported economic prosperity globally, those pillars are cheap labor. Now, when I talk about global economies, I'm talking about just the whole world economy, Europe, America, Asia, and Africa. The pillars that have supported economic prosperity in the last couple of years are cheap labor, globalization of trade, low interest rates, and of course, low inflation rates. And then I'll add again, there's been a lot of peaceful coexistence between countries, especially from the early 1990s. Most countries have had a peaceful cooperation, both economically and politically. So, but starting from 2020, we started to see a bit of change, starting with the COVID pandemic. You know, after the COVID pandemic, a lot of people in developed countries, speaking of Europe and America, were not willing to return to their former jobs. Jobs like retail sales, tourism, healthcare, restaurant attendants, and even plumbers. These guys just refused to go back to their job. Now, the reason you can think about the stimulus that was given to people in the US and in the Eurozone, most citizens got a lot of stimulus from the government. And then again, the lockdown gave a lot of people to reassess their life, reassess their jobs. And in the aftermath, a lot of them refused to go back to their jobs, to their previous jobs. And I guess that has kind of influenced the migration from Nigeria. You know, a lot of jobs opened in Europe and America that attracted a lot of people from developing countries like Nigeria. You know, what we call the Japa syndrome. In part, is attributable to the scarcity of labor in Europe and America. Then fast forward to 2021, we started to see the economies reopening, businesses starting all over. But then supply chains were not ready. You know, the whole world was shut down for months. And when things reopened, we had a lot of demands. We had companies needing raw materials, inputs, and all of that. They couldn't get it. And it led to scarcity of a lot of essential raw materials and industrial inputs that countries needed to restart their economy. Now, what that translated to was the supply chain crisis that we saw in 2021. And then countries began to rethink the idea of globalization. So understand globalization, every country is supposed to be a single productive unit, economically and industrially. But with globalization that accelerated from the 1990s, we started seeing a high level of cooperation between countries, between businesses. So you are Apple, you are based in the United States, you can site your factory in the United States and also have one in Asia, so you can serve that market. You can sit down in the United States and receive semiconductors from Taiwan to produce your phones. So, but with all the crises that ensued in 2021, countries started to rethink globalization and started thinking of localizing their raw materials and their production units. A case in point is what the US government did last year with the CHIPS Act that encouraged more people to produce semiconductors in the United States instead of having them coming from Taiwan and Asia. Now, we're still trying to get out of the supply chain crisis when Russia decided to test the peace that existed in the Western countries by invading Ukraine. And what followed that was a lot of sanctions by the European Union and America against Russia. And then we started having this energy crisis. And the energy crisis ultimately stoked up inflation and sent it soaring to an all-time high. US had like a 40-year high in inflation. Same with the Eurozone. Inflation was at a level that many people had not seen, or many countries have not seen in a long, long, long while. Now, the natural response for central banks when they are faced with inflation is to start to raise interest rates, to try to bring down inflation. Now, before now, I mentioned that the pillars that supported economic prosperity was, one of them was cheap labor, interest rates, and globalization. Now, before now, most of the Western countries had their inflation rate at close to 0 or 1%. So if you invested in markets like the US and Europe, you're not getting essentially more than 1% on long-term bonds. But with the heightening of inflation last year, central banks started to raise interest rates. And they raised interest rate to a very high level. As you can see there, currently, interest rate in the United States has gone up to 4.5%, in the UK, 3.5%, Eurozone, 2.5%, Nigeria, 16.5% before yesterday. As of yesterday, the central bank had raised rates from 16.5 to 17.5%. So we started to see high interest rates. And of course, interest rate is bad for the economy, it's bad for businesses. Why? Because when the central bank starts to raise interest rates, it becomes a lot more difficult for businesses to borrow money. Interest rate on loans increases, and when it becomes expensive to borrow money, it's going to impact on profitability. Profit margins will decline, and then that will be felt in the financial market and in the capital market. So in the US, for instance, you had a lot of, the US stock exchange was dominated before now by technology companies. And these technology companies are very sensitive to interest rate because many of them do not have a lot of cash and they depend on borrowing to run their business. So it led to the decline in their bottom line, their profitability. So that was part of what affected the financial market. And of course, assets like crypto, real estate, you started to see mortgage rates in Europe and America go up, and started seeing a repricing of those assets. So we are seeing some sort of reorganization, moving from an era where you had this low inflation rate, low interest rate in the developed countries to a higher regime of interest rates. And these trends will affect markets like Africa and Nigeria in particular, in the sense that if the interest rate is higher in these countries, most investors will not take the additional risk of investing in markets like Nigeria just because our rates are higher. If I'm getting 4.5% in the United States, it becomes a lot more difficult for that investor to bring in money here to Nigeria. And it affected the capital flows that we enjoyed as a country and as a continent before now. We had portfolio investors bringing in dollar here. And of course, we are all conversant with the dollar scarcity that we've been experiencing in Nigeria. This partly is responsible. Now, talking about growth, there's a lot of fear of recession today. Of course, if you look at the GDP of the UK and the Eurozone, and essentially Japan, you can fairly say they are in a recession already. So predicting a global recession is one that is easy for many analysts today. Of course, recession happens, you are in a recession after it has happened. You just wait for the numbers to come out to confirm the fact that you're already in a recession. So we expect a mild recession in any case, because if you look at most of the Western countries, the US, for instance, the Biden's administration in 2020 doled out about $1.8 trillion to families and individuals just to cushion the effect of the coronavirus. A lot of those monies are still in circulation. They are still in the accounts of these individuals and family. So they have some kind of shock absorber in this developed market to withstand the impact of high inflation. So we expect a recession, but a mild one globally. So in terms of, in summarizing where we are as a world today, number one, we are progressively leaving this near zero interest rate regime globally to a positive interest rate regime. Labor shortage is ongoing for most of the developed countries, Europe and America, but they have also opened their country to migrants from developing countries to come and fill up those jobs. So we are kind of seeing a shift in the labor dynamics in those markets. If you look at the capital market, it was dominated by technology companies before now, but the valuation of these technology companies have started to come down because of high interest rates. And we are now going to see a lot more value stocks instead of the dominance of growth stocks in the market. We are going to see more value stocks dominating the market. I'm talking about healthcare stocks, financials, and a bit of energy stocks dominating the market once again as it used to be before. So that is a shift that we see essentially today. I think you are mute, Shidalu.
Sorry about that, Nathan. Thank you very much for that. That was very enlightening. Now we see what these trends are, what exactly they are. It's one thing to know that there are things affecting the global economy, and it's another thing to know what exactly they are. So thank you for bringing that to our knowledge. Now moving on, back to Nigeria. Inflation rate has slowed a bit from 21.47 in November to about 21.34% in December. And now the CBN has increased the interest rates from 16.5% to 17.5% in their just concluded MPR meeting yesterday. Now, these are last interest, prior to this, the last interest rate hike was in November 2022 from 15.5% to 16.5%. Now, ideally, if inflation is coming down, the CBN is expected to slow rates. So, Nathan, what do you think is the rationale behind the most recent interest rate hike? And also, how does that reflect on our country's general macroeconomic outlook for 2023? Nathan, you're mute.
All right. The action of CBN yesterday actually took a lot of market watchers by surprise, in the sense that very few people expected a 1% rise in interest rates. If you look at the problem with Nigeria, I say that we had pre-existing conditions, even before the global trend started. If you look back at 2021, at the end of 21, inflation was about 15.5% in December 2021. That was when most countries had inflation under control within a single digit. And think about the inflation trend in Nigeria. From 1996 till today, inflation in Nigeria has averaged 12.86%. That's one of the highest in the world. So the issue we are having with inflation today is not recent, it's a pre-existing condition. Again, if you look at the GDP growth rate in Nigeria, it's been very, very sluggish, especially in the last 7 years or thereabout, 7, 8 years. The last time we saw our GDP grow at a rate close to 5% was in 2014, where we had a 6.13% growth in GDP. Since 2014 till date, it's been going from 2, 3 down to zero, near zero. We're negative at some point in 2017. So we already have pre-existing conditions before the global trend kicked in. So the action of CBN for many of us does not really address what we see as the issues in Nigeria. If you dissect the inflation figure a bit further, you see that Nigerian inflation is driven primarily by food inflation and transportation. And food inflation is driven by insecurity. Most farmers can no longer go to the farms because of security issues, kidnapping. Raising rates will not address the security issues that we are facing. Same with the transportation. Transportation is a direct reflection of energy prices. Today, the price of diesel is about 825 naira per liter, while fuel is officially 185. But then, if you're outside Lagos and Abuja, it goes for up to 300. So the situation we see in Nigeria is a bit different. And of course, the CBN has more information than the rest of us. And we want to believe that they are working based on the information that they have, the exclusive information that they have. So, but then from where we see it, from where we are standing today, we feel that raising rates at a time like this, up to 17.5%, may be counterproductive. Why do I say this? You raise interest rate, borrowing cost goes up. Businesses will now have to borrow at a much more higher rate. Now, let me get to the most recent GDP figure that was released by the NBS, the Bureau of Statistics. If you look at that figure, the non-oil sector is actually the major driver of our GDP today. The non-oil sector contributed 94% to GDP, whereas the oil sector contributed just 6%. 6% is actually a decline from 9% in the second quarter of 2022. So today we've gone from contributing 9% in June 2022 to contributing 6% in September 2022. And this is a reflection of the oil theft and insecurity we've been seeing in the Niger Delta. Oil production in Nigeria averaged 1.2 million barrels last year. And we have the capacity to do up to 2.3 million barrels. The OPEC quota for Nigeria is about 1.8 million barrels. What this means is that we can't even meet the production quota from OPEC. And this has impacted seriously our GDP. The GDP as at the last quarter grew by 2.25%. For a developing country like Nigeria, you're not going to catch up with the rest of the world if you are growing at a rate of 2.25%. You have to be growing at a much more higher rate, maybe up to 5 to 6%. So raising rates today is going to impact seriously the non-oil sector that is essentially driving our growth. You are going to increase borrowing costs for them. They are going to reduce their profitability, and ultimately it's going to impact on our gross domestic product. So instead of raising rates, I feel that the central bank should have held the rates constant. Now, moving to the exchange rate, which I touched on a bit before now, we've all witnessed the continuous devaluation of the naira. It's election year. I'm sure what is on the mind of everybody is who is going to win the next election between the three key contestants and what it portends for the Nigeria exchange rate. But then the devaluation we are seeing today has been steady since 1986. We've seen a steady devaluation of the naira. Between 1998 and 2007, it went from below 100 naira per dollar to about 120 per dollar. And then this devaluation of the naira has continued. It's just that it accelerated in the past 8 years, So the question is, are we going to see a halt in this devaluation? And we are looking at two arguments here in support of a devaluation and against a devaluation. If you think of the external reserve, our external reserve has gone down from $40 billion to about $37 billion. That reduces the capacity of the central bank to defend the naira. And as we all know, the central bank has been paying out heavily in terms of petrol subsidy. And with the rise in interest rates in these foreign markets, we are seeing negative capital flows, meaning that there's less money coming into the country for investment than what is going out. And of course, the oil theft, which has contributed negatively to how much the NNPC has been able to remit to the Federation's account. So there isn't so much support for so much support against a devaluation of the naira. The few support we have is just to expect that energy prices stays high, and then that the Dangote refinery comes on stream. And of course, we've seen a current account surplus in the past couple of quarters in Nigeria, which is actually commendable. But then we have more arguments against a devaluation of the naira than in support of a devaluation than against a devaluation. So we expect the official exchange rate at the end of 2023 to, depreciate to around 505 naira per dollars. I'm talking about the official exchange rate, not the parallel market rate, which of course we know may be a lot higher than where we see it today. Okay, and then finally, speaking on the upcoming general election, the relationship between the Nigeria stock market and elections in Nigeria is more like a love-hate relationship. The trend we've seen in the past 15 years or thereabout is a trend where prior to the election year, the stock market goes down and then starts to recover after the election. This has happened in 2009, during the 2011 election, 2015 election, and the 2019 election. The exception being this year. Last year, 2022, the Nigeria stock market was one of the best performing in the world. We achieved a return of about 19.6%. So there's uncertainty as to what happens this year. And what stokes this uncertainty about the stock market is the lack of clarity in policy direction. We are not always sure what the next president is going to do. We're not sure what his policies will be. And in fact, in 2011, 2015, there was a lot of fear of insecurity, a bit of which exists today. But these factors always drags the stock market down. So in terms of our outlook for what the stock market will do this year, we don't expect a negative return this year. Of course, there's the sentiment that all the three contestants are pro-market candidates. So we do not expect a loss in the Nigeria stock market But in our opinion, the year-to-date return at the end of 2023 will be within single digits, about 9 to 10% at the end of 2023.
All right. Nathan, thank you so much for that. So basically, what stuck out for me was that, according to you, the interest rate hike by the CBN is counterproductive, if I'm correct.
Yeah.
Okay. Then, so generally, because in the developed countries, basically, when inflation rate goes up, the next thing to do is to push up interest rates so that it can drive down inflation in developed countries. But in a country like Nigeria, um, the driving factors of inflation in this country are not, it's not necessarily interest rates. It's mostly insecurity, like you said, oil thefts, and all whatnot. So being counterproductive means it will impact negatively on the non-oil sector. So it will increase borrowing costs, and it will reduce productivity, which will negatively impact the economy generally. So,
Correct.
so thank you very much for that. Thank you for that. Before we move on, um, basically, we would like to, for the participants, we would like to give out some customized gifts to some of you. You just courtesy of Silvest Financial. So I'm just going to ask a very simple question. It's been mentioned here. I mentioned it. Nathan has mentioned it too. So it's very easy. And I'm very sure a lot of us are with our phones. So it's not even going to be hard to access Google. So the question is, what is the current Nigeria inflation rate? What is the current Nigeria inflation rate? So we'll just pick the first five correct answers from the chat. So you can go to the chat box and just put it down there. What is the current Nigeria inflation rate? Thank you very much. Okay, so moving on, Nathan. Um, with all this information you have laid out, how do you think investors should digest? It's a lot of data. You can agree with me. It's a whole lot of data you're putting out there. So my question is, how should investors digest all this data? And generally, do you see any opportunities for investors with all the data you've given and the current global economic outlook?
Okay, Idalo. For me, as an investor, you have to understand that at every market downturn, there is an opportunity. You know, it's only human that we tend to buy assets when the prices are rising and sell them when the prices are falling. But actually, the reverse should be the case. You should be interested in buying assets when the prices are falling and selling them when they are rising. But you know, as human beings, we have this behavioral distortion that makes us take overweigh recent events, you know, and panic into taking decisions. So for investors, you have to be selective today on how you assess the global capital market. You have to be very, very selective. You know, like I said at the beginning, there's some sort of reset, a reorganization of global economies going on. And you should position your portfolio along those lines of the reset. Now, if you look at the Nigerian markets, as I mentioned earlier, the Nigerian stock market was one of the best performing last year. The return was 19.6%. But now, as an investor, what you really care about is your after-tax and inflation return. That is what can grow your wealth in the long term. What you get after paying tax and paying inflation. Because you can all agree with me, last year we're buying petrol at, is it 120? Today, you are buying it at 185. In some instances, 300. So if you are not growing your wealth after inflation, you will not have enough money to live at the same standard of living you were living last year. Now, what we did was to adjust the return on the stock market for inflation. That is the chart you are seeing on the left-hand side. And what we discovered was that for most of the time, the return was negative, meaning that investing in the Nigeria stock market, you are not really growing your wealth. The few times it was positive was in during the 2006, 2008 stretch, just before the last financial crisis, and then between 2012 and 2014. The most recent number from 2022 indicated a 1.3 real return after adjusting for inflation. So we do not have a lot of, we are not going to be exposed in our portfolio construction. We are not considering the Nigeria stock market yet. And for obvious reasons. One, the economy is not growing at a very high clip. Currently is growing at 2.25%. What we want to see is the Nigeria economy grow at the minimum of 5%. At that point, we can start to think of allocating funds to the Nigeria stock market. And of course, you have all the political uncertainties. You have a very high interest rate and inflation rate. That is bad for the market, it's bad for businesses. For the Naira bond, it's essentially the same thing, the Naira bond. We have, currently your 10 years bond is about 13% for the Nigeria 10 years bond. If you factor inflation at 21.34%, you are left with barely 8% in red. So the return on the Nigeria bond market adjusted for inflation is currently negative. But then if you look at the Nigeria Euro bond, that is where we see value, the Nigeria Euro bond. For those of us who don't understand what it means, Euro bonds are dollar-denominated IOUs issued by the government and corporations in Nigeria. Now, the yields on these bonds have turned to double digits between 2021 and 2022. As you can see, this is a chart of the Nigeria 10 years bond. The price has really come down. It's trading at a discount of 83%. So the Nigeria Euro bond has become very, very attractive for many investors. And the reason is obvious. It's a better hedge against inflation. Because since it's a dollar instrument, you are not charged the high inflation rate we are seeing in Nigeria. And it again provides many people with current income to meet their obligations like school fees. We know a lot of people have dollar obligations in terms of their own school fees, children's school fees, medical bills, money for vacation and all of that. So investing in the Eurobond has become very, very much attractive for a lot of investors. However, like I said, investing today requires investors to be very, very selective. You have to be very, very selective because a lot of risk exists: default risk, sovereign risk, and interest rate risk. I'm going to break this down. By sovereign risk, I'm talking about the risk of the country where you are invested. If you're investing in any country, you have to look at the global risk of that country. As human beings, we tend to look at risk after the risk factor has crystallized. An example is what investors are seeing in Ghana today. The yields on Ghana bonds have shot up very rapidly in 2022, and it attracted a lot of investors to invest in that market. But today we are seeing the Ghana government defaulting technically and trying to renegotiate those loans, essentially. They are at the verge of renegotiating these loans, essentially. So we are saying that investors have to be very cautious in investing in this market, whether the Eurobond market or any other asset class for that matter. Again, interest rate risk. if you are buying a bond, understand that if you buy a long-term bond, you carry interest rate risk in the sense that if you sell before maturity, there's a chance that you may sell and lose some of your investment. You know, where we are very bullish is with the US equities. You know, as I said earlier on, the US has a very healthy consumer balance sheet. We forecast that even if they are going to see a slowdown, it's going to be a very mild recession for 2023. With the loss in the capital market last year, the US capital market from the S&P 500 declined by about 19% loss. You know, that has made a lot of stocks on that exchange a lot cheaper. And if you look at the long-term annualized return, the annual return on the US market is about 11% per annum. You know, I'll get to a bit of a practical demonstration of why we find our market very attractive. And it's a thing called the 60-40 portfolio. You know, as a disclaimer, this is not an investment advice. And this is only a model. You know, a lot of investors apply this model in different weights. You may have 10% stock, 90% bond. You can have 20% stock, 80% bond. It depends on your risk threshold. So before you apply any of this strategy, consult a professional. You know, but what this 60-40 portfolio does is to provide investors with a stable dividend income, diversify their risk, and provide periodic incomes that they can use to meet obligations. But based on historical returns, if 10 years ago an investor invested $100,000 in a 60-40 portfolio, by 60-40, I mean 60% invested in the US stock market through the S&P 500, and 40% invested in the Nigeria Eurobond that 10 years ago was paying 8.5%. That investor today will have $255,000. But like I said, how investors apply this model varies depending on their risk threshold. But the popular name for this model is called the 60-40 portfolio, which a lot of investors apply to build wealth over a long period of time. But again, I repeat, you apply this based on your risk tolerance level. Now, in terms of how to be a bit more cautious when investing in stocks, for us, we select stocks based on the consistency of their dividend payment. So we look at stocks that have been paying dividend consistently, not just paying, increasing dividend consistently for 5 years. We look at stocks with healthy return on assets. The stocks we invest in must have a very healthy free cash flow, less leverage, meaning that they are borrowing less, and less volatility. We do not fancy volatile stocks. Then in terms of investment themes that we are looking at, we don't just buy stocks from every sector. We follow a thematic approach in selecting stocks. And one of the key investment themes that we follow is dividend income. You know, dividend will help you moderate risk in your portfolio. As an investor, you're essentially investing for one, dividends, and also investing for dividends and also investing for capital appreciation. But in a volatile market like this, you're not going to get a lot of capital appreciation. So having some level of dividends in your income will help moderate the risk in your portfolio. And of course, healthcare. You know, healthcare is a defensive sector in the sense that whether there is a slowdown or not, people will still fall sick. So we look out for healthcare companies, particularly in the biotechnology space, those that are doing a lot of research. Today, we have a lot of research going on to cure all sorts of ailments, cancer, kidney problems, heart diseases, and all of that. So we are looking out for those companies in advanced stage of their clinical trials. We also like semiconductor stocks, cloud computing, renewable energy. The world is going green today. And for us, we also want our investment to create some impact in the world that we do. So we favor a lot of companies that are invested in renewable energy. And I'm sure many of us have heard about the chat GPT, and all the innovations going on with artificial intelligence. So we're also monitoring these trends and identifying companies that are advanced and market leaders in those sectors, including electric vehicles and technology. Now, here is a few tips for us as investors. At a time like this, the temptation for many people is to sit on the sideline and do nothing, just keep cash. We do not advocate you to keep cash. Timing the market, people talk about buying when the market is very low. The problem is that you do not have any signs. You do not have any gauge to know when the market is low. While you are waiting, the market can suddenly take a different direction. So we advocate you to stay invested and not on the sideline. Stay diversified. You cannot be right every time, no matter how good you are. No professional will guarantee you that his prediction will be correct in 6 months' time. Nobody predicted the COVID pandemic. So it makes sense to stay diversified. Pay attention to company fundamentals. A lot of time as investors, we build our hope on expectations, ignoring the fundamentals. When you invest, you are investing in real businesses. You're investing in real businesses. You have to look at their cash flow, the factors I mentioned earlier on, the return on assets, cash flow, are they borrowing a lot? You have to look at all of those factors and be sure that you are investing according to your level of risk. Then one strategy that I'll recommend for staying invested is to use what we call dollar cost averaging. So if you have like $1,000 and you want to buy a particular stock, rather than wait, you can buy at intervals, $200 this month, $200 next month, and that $200 the month after, and complete that in 5 months. Now, what you achieve is that you are going to buy at different prices. If you average those prices, it will be likely lower than the highest price and close to the lowest price. If you look at the example here, this stock was at $100 the first month. The next month it went to 120, went to 80, went to 90, went to 170 and 175. And this investor invested $300 in each month. At the end of the day, his average price came to 102, which is a lot lower than the 175 at the end of the 5-month period, rather at the end of the 6 months period. If this investor was waiting for the market to dip, you may just end up 5 months later, it's more expensive than where it started at $100. So dollar cost averaging is what a lot of investors use to moderate their entry price.
All right, Nathan. Are you finished?
Yes. Yeah.
All right. All right. Thank you. Thank you very much. Thank you very much. So we'll just move on for one of time. We'll move on to the next thing. Um, how I think the question is this: how all these predictions you mentioned, they are based on the correct facts at hand, and nobody knows the future. So I believe. So there is no guarantee that with all being done by the CBN, the US Fed, and other countries around the world to reduce inflation to their target marks, that they would achieve it, and navigating out of recession would work. So and then we still have the tension between Russia and Ukraine and the US, China, Taiwan conflicts. So at the end of the day, this is an outlook. So the question is, how can investors navigate these uncertain times without losing so much value in their investment portfolio?
Okay, I think we are almost out of time, Chidalu. And I already walked through navigating these uncertain times in my last presentation. Staying invested, I think it's necessary that I re-emphasize it again in case anyone missed it. Stay invested, don't sit on the sideline, don't sit on cash. Cash is expensive to sit on today, because if you sit on cash, inflation will take it away from you. If you have ₦1,000,000 today, inflation is taking away 20% from your ₦1,000,000. In a year later, if you still have ₦1,000,000, it will only buy what you could have bought with 800,000 today. So staying invested is a no-brainer. Diversify. Nobody can be very right. Keep your risk low. Diversify across asset classes, across securities, hold bonds. A lot of people want to get exposure to stuff like cryptocurrencies and alternative assets like options and all of those. These are very volatile assets. While they can make you a lot of money, they can haul you into poverty. So for most investors, I will not even advocate exposing yourself for this alternative asset for more than 5% of your total wealth. So if you are doing crypto, for instance, you shouldn't, if you must do it, it has to be a small percentage of your wealth. I don't know anyone who can invest more than 5% of his wealth in crypto, including Aliko. So investing 80% of your money in risky assets is not for a time like this. Again, understand that companies, stocks, they are not symbols in the market. They are real businesses. Understand what they do actually. When I started investing in stocks, one of the first things I do is to if I go to the supermarket, if I'm not seeing your product, if I don't have one-on-one experience with your product, it tells me that I shouldn't buy your stocks. Because how is a company going to make you money if the business is not on the street, if you don't feel the impact of the business in the real economy? And of course, I talked about dollar cost averaging and investing at your risk threshold. We do not all have the same level of risk appetite. If you look at the 60-40 portfolio I spoke about, why some people can invest 60% in stocks and 40% in bonds, when you get to 50, 60, when you are close to retirement, you are doing less of stocks. A lot of people who are retired, you actually advise them to do 100% bonds, just to keep the risk very low. So understand your risk and invest accordingly.
All right. Thank you very much, Nathan. So the final thing I will look at, meanwhile, if you have any question, please do well to drop it in the Q&A section. We'll get to it. Nathan, I think the final thing is this. You've made mention of a whole lot of things. So my question is, where does Savest come in? How can Savest Financial help?
Okay, Savest is a licensed investment advisor. We are licensed by the Nigeria Securities and Exchange Commission. And I'm sure that for many of us, we may not have heard of, or we may not have worked with an investment advisor before. But the job of an investment advisor is to help us take the best financial decisions. Your financial advisor is a bit like a doctor. So we diagnose you, find out what you need, and help you build wealth over a long period of time. So what we do is to support you through the process of accumulating wealth, protecting, preserving, and distributing your wealth over multiple generations. We essentially serve individuals, families, and institutions. And what we do for individuals include private wealth advisory, financial planning, ethical investing for people who want to invest according to their religious beliefs. There are a lot of people who don't want alcohol, tobacco, prostitution stocks, armament, and the likes. Also, there are people who want their portfolio to create some sort of impact in the world in terms of green energy investing, ESG investing, that's what we call it, investing responsibly in a way that protects the environment and humanity. We also support people to write wills, and the alternative, trust and estate planning process. So I know writing a will is something that is a touchy topic for many people, but there are also alternatives to having a will. You can set up a trust, you can have a joint account. I mean, there are a lot of estate planning alternatives that investors can look at. So our goal, our job is to help you identify the most suitable ones and help you draw up a plan for it. Retirement planning, part of what is responsible for the level of poverty we are seeing in Nigeria is lack of proper retirement planning. So people retire without planning. It doesn't matter how much you make while you are working or from your business. If you don't have a good plan, if you don't invest rightly, when you get old and retired, it becomes a lot more difficult to keep all the money you've made. We also support people through tax advisory, separately managed accounts, career planning. And then for wealthy families, we help them with multi-generational wealth planning, documenting their legacy and transferring them from one generation to another. And for institutions, we serve small businesses and startups, pension fund managers, government institutions, foundations and endowments, cooperative clubs and investment clubs, just to help them optimize their resources, manage their assets against their liabilities for those who have it, and then establish adequate governance structure for them. Now, I'll mention finally our model portfolio. We have these model portfolios. You can head over to our website and look at them. We're going to be launching them starting from next week. We have 4 of them, and we're going to launch them at intervals starting from next week. So these model portfolios can be reproduced by investors. But again, you have to get the proper guidance of a professional. This is our contacts. The easiest way to reach out to us is to go to our website, savesfinancial.com. If you want to speak with any of our advisors, just hit the talk to an investment advisor button on our website, and we'll schedule a date to speak with you.
All right. Thank you so much, Nathan. This has been a very insightful section. Personally, I've picked quite a number of things, and I'm happy to see that we have some people who have questions. So I'll just ask the questions immediately. So we have one. Someone says, what can my 20K, my 20,000 naira do in today's investment climate? Over to you, Nathan.
A lot. So one error that a lot of investors get into is thinking that I need a lot of money to start investing. What you need most importantly is a plan. Once you have a plan, you'll find out that your 20,000 can do a lot. Even if it's an ETF, there are exchange traded funds, there are mutual funds, there are dollar mutual fund, Naira mutual funds, and all of that investors can look to. So your 20K can do a lot in this climate. It will get you started on your investment journey, at least.
All right. Thank you, Nathan, for that. Hopefully the person who asked this question, hopefully you got your answer. But if not, you can always reply, come up with another question. So the next question is this, Nathan. So this is a long one, so I'll just read. I invested in the pre-IPO shares of a transport company that is producing above ground electric vehicles running on high strength string rails. It aligns with the investment themes of renewable energy and electric vehicle. How do you advise on pre-IPO investing, especially if there is a high demand for the company's products and services? So Nathan, did you get that?
Yes, I got it. And
right.
I mean, this Unit Sky String Technology Limited, I mean, you have not heard of this company before? And investing in pre-IPO comes with its own downsides and upside at the same time. Because you are investing in a company that, like you said, has a lot of demand for its products and services. There's a lot of demand. So you expect that when the company gets to the market and raise money in a real IPO, the price will really go up and you make a lot of returns from there. But the downside is that you do not have a lot of information because most of the pre-IPO companies do not have public information for you to scrutinize. I talked about looking at companies' fundamentals. It's important before investing. So the question you have to ask, like I said, I don't know much about this company, and I'll definitely look it up after this webinar. But then you should have adequate documents to study the company's fundamentals. But what you see with most of these pre-IPO companies is that they are not yet regulated, so they mostly do not have their financials in the public domain for investors to scrutinize. So, but then pre-IPO companies, investing in pre-IPO companies, you need information. And again, most of the promoters and the founders of these businesses have, there's a lot of information asymmetry in the sense that there are a lot they know that you as an investor may not know. So it depends on the level of information you have about the business.
All right. Thank you very much for that, Nathan. The person who asked the question, I really hope this answers your question properly. Thank you very much. Because we're out of time, it was supposed to be a 1 hour session. Nathan, I would just ask you to. Okay, someone asks if they can get the slide, your presentation slide, Nathan.
Yes, definitely. It will go out
Okay.
after the session.
Okay, for who asked the question, the slides will go out. The slide will go out at the end of the session. So we just have one more question before we just round it up. Someone asked, "What are the benefits or guarantees on investments made with Safest Financial?"
Okay, so Savers is an investment advisor. So you do not make investments with us directly. We advise you. And the benefit of working with an investment advisor is really that you are working with somebody who has no bias. If I'm a broker, I'm trying to sell a product to you. So whether that product is suitable for you or not, I'm going to force it on you. But because we are advisors, we are fiduciaries. That's what we are called. We work in the best interest of our clients. We are not trying to sell you a particular product. So imagine yourself going to a hospital. The doctor is going to diagnose you and decide on what is really wrong with you before recommending a medication. So our job is a bit like that. We do not have any medication that is ready for you now. But when we work with you, we'll find out what your needs are and then recommend appropriately. So the benefit of working with a firm like Savers is that you're working with somebody who is unbiased, professional, and working in your best interest. We
All
are
right.
paid based on the size of assets that we manage. So we are motivated to help you grow your assets because the higher the level of your assets, the more we get paid.
Okay. Hope that answers your question. So investments are not made with Safest Financial. The last question, Nathan, someone said you did not agree with the rate increase, that's the interest rate increase after the MPR yesterday, but I have heard many analysts applaud CBN for this move. What are your specific reasons for disagreeing?
Now, if you're a business owner in Nigeria, or if you have borrowed money from any bank, you know that the minimum rate at which you get money today is about 30%. And for many institutions, it's way, way higher than that. You know, for anybody who borrows money in this economy, you are paying higher than 30%. So imagine as a business paying 30% in interest for monies borrowed. That is going to slow the economy. We're already dealing with insecurity. We're dealing with a high level of poverty. So raising rates for me, will it bring down inflation? I doubt. But if the war between Russia and Ukraine ceases and we see the energy crisis globally abate a little bit, price of petrol and diesel will come down, which will bring down our inflation rate. It's not the interest rate that is going to do that. Again, we are looking at insecurity. I mentioned that we are seeing a high level of food inflation. Food inflation today is around 23% for food inflation. What is causing food inflation? Now, understand why central banks raise money, raise interest rate. You raise interest rate if there's so much money in circulation and you're trying to mop up excess liquidity from the economy. So the question is, do we have too much money chasing few goods in Nigeria? Is that the case? So I try to keep it simple, trying to keep it simple. If you are not trying to mop up, and you are doing this at a time where we have redesigned the Naira. So naturally, you're going to have less money in circulation from January 31. Many of us have not even seen the new notes. So that tells you that there will be few notes in circulation, there will be few money in circulation after January 31. So I feel like raising rates will slow down the economy even more. Of course, the central bank is motivated to raise rates to attract foreign investment. That I know. They want to keep attracting foreign investment into Nigeria. But again, what does it do to the broad economy? You're going to attract foreign portfolio investment, but not foreign direct investment. These are two different things. You have foreign portfolio investment and foreign direct investment. Foreign direct investment is foreign money coming to invest in agriculture, build manufacturing plants in Nigeria. That is what we want, not people bringing in dollars to invest in the Nigeria bond market. That growth will not be sustainable.
All right. Hopefully that answers your question on the interest rate hike and Nathan's disagreements with it, or with what it's supposed to achieve. Okay, Nathan, I'll just give you an opportunity to conclude with us before we close out this session.
Okay, so this is the first webinar organized by Savers Financial, and we are hoping and expecting to do this more frequently, at least every quarter. And I want to appreciate everyone who has joined this webinar. Thank you so much for connecting with us, and we hope to hear more feedbacks from you guys. Yeah, thank you. And for future webinars, we want to keep it within an hour. So we'll always start as scheduled and end within 1 hour. Again, thank you so much for spending this last 1 hour with us.
All right. Thank you very much, Nathan, for that. Just to reiterate on what Nathan said, so Savest Financial, like someone asked, is an investment advisory firm. So you don't make any investments with Savest Financial. Typically, Savest Financial just advises you on how best to manage your finances and your investments. Nathan mentioned something about speaking with an investment advisor. So you can go to www.savest-financial.com. Let me go again, www.savest-financial.com. Just at the top section, you will see speak with an investment professional. So you just need to click on it, and then you can schedule a meeting to speak directly with an investment advisor at Savest. Or alternatively, you can go to Google. Once you put in Savest Financial, the website will pop up, and you can do the same. So thank you very, very much, Nathan, for gracing this insightful session and for all the knowledge you dished out. I would also like to thank all participants who signed on for sharing their time with us for this engaging session. For the question that was asked on the Nigeria inflation rates, we got series of answers. So for the first 5 people who gave the correct answers, we'll reach out to you via your mail for your customized gifts from Seavest Financial. Thank you very much. So on that note, I will say until we come your way again, thank you once again and do enjoy the rest of your day. Bye.